Got 10:01, so we'll get started. So good morning, good afternoon, everybody, and thank you for registering and attending our call today. We'd like to welcome all of our originators, real estate professionals, and guests at PacRes Mortgage and our affiliates. We believe we have a very insightful and timely webinar today focusing on the 2024 housing market, interest rate forecast, as well as strategies to generate more income now. Today, we are pleased once again to be joined by Dan Habib, Chief Revenue Officer and one of the founders of MBS Highway, a trusted source of real estate and mortgage market intelligence trusted by thousands of industry professionals, including all of us at PacRes. Dan's been an educator in the mortgage industry for nearly 18 years. He was recently honored by the National Mortgage Professionals magazine by being named one of the top 40 under 40 mortgage professionals in the country. He was also presented with HousingWire's Rising Star Award, which acknowledges young leaders in the housing industry. Today, Dan will be covering things like a deep dive into the timing of Fed rate cuts and tapering of quantitative tightening, outlook for rates, housing, and recession, strategies to overcome customer and realtor challenges and turn those into opportunities, and ways to generate more income right now. This call will be recorded and made available to everybody after the call, and we will be monitoring the chat box throughout the call, and hopefully we'll have some time for Q&A with Dan after he's all done. So sit back, take notes, ask questions, and enjoy the presentation. With that, Dan, I'm going to turn it over to you again, and thanks so much for joining us.
Well, thanks for having me, Dave. It's an honor to be with all of you today. Listen, let's jump right into it because there's a lot to go over. Really, what I want to cover for you is what the outlook is for 2024. What's going to happen with mortgage rates? Obviously, that's going to be a big impact on activity and volume levels out there. And a big influence on that is going to be the Federal Reserve. So we're going to do a deep dive as to what the Fed's next moves likely are going to be. When are they going to start cutting rates potentially? And also, maybe even a bigger influence is what are they going to do with their balance sheet reduction that they've been performing since 2022, which has really been, putting a lot of supply out there of bonds in the market. We're also going to take a look at real estate because the media, they've been talking about a housing bubble for the last few years, and last 2 years we've seen 6% appreciation. So what does the outlook look like for 2024? And as Dave mentioned, want to go over some of the challenges that I know you guys are facing every day and strategize with you on some ways we can turn those into opportunities and generate more income right now. So let's jump into it. The title for the presentation is 2024 Forecast for Success. And listen, there's been a lot of negativity out there regarding our industry. You may or may not have seen articles like this from American Banker saying, is it time to quit mortgage and real estate? And obviously, what they're citing is the lack of volume levels, seeing some of the lowest purchase index levels we've seen since 1994, 1995. And you guys very much are the survivors. Right? It's kind of like in Squid Games, you've made it to the next round, right? So we've seen probably around 50% of the industry leave. So while that, certainly a challenging time that we've gone through, I think many people are happy that 2023 is over. It certainly leaves a lot more opportunity for you out there. And there are still transactions that are being done. Of course, nothing like we've seen in the previous few years, but in 2023, there was about 378,000 transactions that occurred every single month. Now, if you look at some of the forecasts, it's expected for things to get better this year and even better next year. So a lot of the forecasts out there from people like the MBA looking for a 19% increase in transactions and then a further increase in 2025. So listen, while it's a lot tougher than it was a few years ago, there's still a lot of opportunity out there. We need to make sure that we're getting as much of that share as possible. And hopefully today's talk and the knowledge and some of the strategies will help you to do that. So it's no mystery out there. One of the big influences of the year is going to be the Federal Reserve. What are they going to do with their Fed funds rate? So the Fed had this inflation problem that the Fed partially created, as well as all of the stimulus out there created too many dollars chasing too few goods, which is the definition of inflation. And we had 40 plus year high inflation. So the Federal Reserve used their tools and they hiked rates. So this is not them hiking mortgage rates. They hike something called the federal funds rate, which is an overnight rate that banks lend to one another, but it certainly has direct influences on things like credit card rates, car loan rates, and it can also influence mortgage rates in the overall bond market. So they hiked 525 basis points, one of the fastest, most aggressive paces that we've seen in history. And consumers were certainly all feeling this. So at the Fed's latest meeting that they had, not the one that they just had in January, but the latest one they had in December, where they released their summary of economic projections, they released a few things, one of which was the dots plot. So this shows you, out of the 19 Fed members in total, where they all think the Fed funds rate is going to be. And this is something that you could derive, hey, how many Fed rate cuts is the Fed pricing in? And if you take a look, the numbers, some Fed members, very hawkish, think that there's going to be 0 cuts this year. One person thinking there's going to be 150 basis point of cuts, but the average here is around 75 basis points of cuts in 2024. So if they were 25 basis point cuts, that would mean 3 rate cuts this year. So this certainly, if and when it happens, will help mortgage rates and rates in general. But take a look at 2025 and 2026, what the Fed's expecting. So things are not just expected to get better this year, but even better in 2025 and even better in 2026. But we can kind of project out here when the Fed may begin to cut rates, because initially it was thought the Fed may cut rates in March, and they have a meeting coming up in just about 8 days. But now that really seems to be off the table. They have another meeting in May. It was thought originally they may cut there. And now Fed rate cuts, which we'll go over, really are being priced not until June. And part of the reason for this is because inflation has been a little bit hotter than the Fed would like. We made some really good progress on inflation from the highs that we saw, but it's kind of been a little bit stubborn over the last few months, not progressing as much as the Fed likes. So the Fed has made it very clear that they are not going to wait for inflation to get to their target of 2% before cutting rates. That would be too late. It's almost like, if you're driving down the highway and you need to get off at an exit, but you don't start braking until you're past the exit, right? So you want to make sure in advance of this that you start slowing down. So the Fed's not going to wait till we get to 2%. But when we look at their favorite measure of inflation, which is PCE, or personal consumption expenditures, the latest reading on a year-over-year basis is at 2.85%. So they want this to go down to 2% on a sustainable and consistent basis. It's still too hot for them, but you can make some educated projections as to what we expect the numbers to come out at, and then what that would do to that year-over-year inflation rate, and then at what meeting maybe they would anticipate a cut. So if you project out over the next few months that we get a 0.3 of a monthly reading on core PCE, and then you factor in the numbers on the year-over-year calculation that you're replacing from 2023, you could see what happens with the year-over-year inflation rate. And in the February release, which we'll be getting at the end of this month, we should see a little bit of a decline, but not major. And then further decline in March, further decline in April. But I think by the time we get to that June 12th meeting, I think we will be pretty close to the Fed's target, somewhere in the 2.6 range. And I think that may be enough for the Fed to start thinking about cutting rates, certainly by the July meeting. But unfortunately, not expecting any cuts at March or at the May meeting. And if you take a look at the market has something called the Fed futures. This is where the market tries to handicap, hey, when may the Fed begin cutting rates? And you can see the chances at March are 1%, May 17%. But the first meeting where it's greater than 50% chance is at that June 12th meeting. So market's certainly agreeing with this, that, hey, we think by the June meeting, we may start to see rate cuts happen, which would certainly help things. But there is an X factor that I really want you to keep an eye out for and pay attention to, and that is the unemployment rate. So the Fed's really looking at 2 main things to determine what's happening in the economy and when we could begin cutting rates. One is obviously inflation. They want to see it sustainably going towards their 2% target. But the other is the labor market, and specifically the unemployment rate. If we see the unemployment rate start to move higher than the Fed anticipates, that may pressure them to cut rates sooner and potentially more aggressively. If you look at that same summary of economic projections that they released at that December meeting, you can see where the Fed members believe the unemployment rate is going to be in 2024. And the vast majority of them see the unemployment rate between 3.8 and 4.1% during this year. So if we see something above that, I think the Fed's going to be pressured to cut and potentially cut more aggressively. If you look at the Congressional Budget Office, their forecast is for the unemployment rate to go up to 4.4% this year. And speaking of the jobs data, I think it's important to look at the latest jobs data that we just got last week. So we get this jobs report every single month. It's usually the first Friday of the month, unless it falls on the first from the BLS, so the Bureau of Labor Statistics. And boy, the last several of these that we've seen, they haven't been too friendly to the bond market or to mortgage rates or to us in general. And they've been having a lot of problems. These numbers have been coming out exceptionally strong and not really jiving with other reports that we're seeing out there, whether it's confidence from small businesses, whether it's the ADP employment report. It's been a bit wacky and just not really making sense. If you remember back, that January reading that we got, it showed 353,000 job creations, which ADP only showed a little over 100,000. And this really caused the bond market to sell off and mortgage rates to move higher. But if you dig deeper at the numbers back then, it was all due to seasonal adjustments. The actual raw number was negative 2.5 million jobs, but they adjusted it higher by 3 million jobs, basically a keystroke for seasonal adjustments, which certainly seemed a little bit suspicious there, right? So why would you have such a huge seasonal adjustment? Now, if you look at the latest data, it showed 275,000 jobs created in the month of February. Now, this was still stronger than the market estimates, but a theme that we've been seeing is they report high numbers and then they revise them lower. That 353,000 January number, well, they revised it lower by 124,000 jobs, and they revised December lower by 43,000 jobs. So I don't anticipate this number to hold. I actually think both January's number and February's number are going to be revised lower further. So I don't think the jobs picture is as strong as those headlines would illustrate. Additionally, within the jobs report, there's two surveys, believe it or not. There's something called the business survey, where you get that headline job creation number. And then there's something called the household survey, and that is where the unemployment rate comes from. And interestingly, it has its own job creation component. So the business survey, they use a lot of modeling and such. That showed 275,000 jobs created. But the household survey told a completely different story. It showed 184,000 job losses. I mean, talk about a tale of two reports. And that caused the unemployment rate to jump up from 3.7 to 3.9%. Now, that's pretty significant because that's not far from where a lot of the Fed members think the Fed funds rate is going to remain beneath, right? Remember, 4.1%. If we see a number, I just think above 4%, that might start to pressure the Fed. So now we're not that far away at 3.9%. And if you just take a look at this household survey over the last 3 months, we've actually seen about 900,000 job losses. So if this trend continues in the coming months, you could see that unemployment rate start to really rise. And I think that could pressure the Fed to cut sooner and more aggressively. So definitely keep an eye on that unemployment rate. Now, inflation, although it's kind of been a little bit stubborn at recent levels, it's made a lot of progress. I mean, remember on the Consumer Price Index inflation report, this thing was at 9% not too long ago. So inflation has come down sharply. It's important to note, though, when people talk about inflation coming down, the prices that we've seen that have increased, they're still baked in. A lot of times you'll see people in the media, they'll talk about, oh, inflation's cooling, it's coming down. And then consumers are like, what are you talking about? I'm not spending less when I go to the store. I'm not spending less, on all my different purchases. And what they're talking about is the rate of change has cooled or has slowed. So in the Fed's ideal world, they only want to see prices go up 2% per year. But all the inflation we've seen over the last few years, that's still baked in. We're just looking at slower rates of increases going forward. So it's important to note that when we're talking about inflation, unless you see negative year-over-year inflation numbers, prices as a whole are not actually coming down. We're just talking about a slower increase as the Fed's target. But with a big decline in inflation rates or the percent change, you would expect to see something that we always see throughout history, which is mortgage rates come down more so than they have. We know mortgage rates, they peaked at around 8%, and now they're probably close to 7%. But with the move lower that we've seen in inflation, one might have expected to see a better reaction in mortgage rates. But there's some reasons why we haven't that I want to go over with you. One has to do with the removal of the debt ceiling and us saying, you know what, let's pack on another $2 trillion of debt. Well, this has a big impact on the bond market and rates, because how do we come up with this money? We don't just print it using a printing press. What we do is we issue debt, or we issue treasuries. And those treasuries, guess what? They need to be absorbed by the bond market. So you have more supply out there. There's going to be demand at some level. But to absorb all this debt, guess what? It 8% rates. We also had a downgrade on our credit rate. Now, you guys know what happens when somebody's credit score goes down, right? They get a higher rate. Well, it's not too different here with the United States, and our credit rating getting downgraded from AAA to AA plus certainly didn't help things either. And on top of that, you have the Federal Reserve at a time where you have all this supply that needs to be absorbed by the bond market. You have the Federal Reserve that is not only not buying, but they're allowing their balance sheet to reduce or to roll off. And I want to take a minute to explain this because this could be potentially even more important than rate cuts. They're certainly going to be something that can help us. But the big reason why rates have stayed high is because you have this massive supply of debt and treasuries and bonds that has to be absorbed by the bond market. Well, the Federal Reserve, they used to really help mortgage rates. So if you remember after COVID, they wanted to help expand the economy, help us recover. They cut rates to zero, and they did something called quantitative easing. You may have heard that term. Essentially, what that means is they were buying trillions of dollars of mortgage-backed securities and treasuries. And the reason they did that is to keep rates artificially low, because when borrowing costs are low, guess what? People borrow and the economy expands. And it certainly did help us to get out of the doldrums that we were in economically from the COVID impact. And you could see this is a chart of their balance sheet. So just look at how their balance sheet just kind of blew up here like a balloon to $8.5 trillion of bonds and treasuries that they were holding. Well, after the emergency-like conditions, they said, you know what, we need to kind of normalize this. So not only are they not buying anymore, they're reducing their balance sheet by about $1.1, $1.2 trillion per year. So think about the impact this has. You have all this supply coming to market that has to be absorbed. And then you have the Federal Reserve, who used to be the biggest buyer of bonds and treasuries. Not only they're not buying, they're reducing their balance sheet by 1.1, 1.2 trillion per year. So this combination is part of the reason why, even though inflation has come down, mortgage rates have remained stubbornly high. And you can see their balance sheet since 2022, they've reduced it from 8.5 trillion down by about 1.5 trillion to 7 trillion. Now, here's what could happen if the Federal Reserve starts to slow down or taper their reduction, because the Fed may be pressured to do so. You see, they've come out over the last few weeks and they said pretty clearly the main focus of our March 20th Fed meeting, it's not going to be rate cuts, but it's going to be to talk about the balance sheet. So I think they're going to have some in-depth discussions on when they may begin to reduce, or I should say to taper the reduction of their balance sheet. And when they do that, that means that they're going to allow less to fall off their balance sheet, and they're going to take a portion of it and actually reinvest that money back into mortgage bonds and treasuries, hence absorbing a lot of the supply out there. And that could really, really help things. Without getting too technical, there's also something called reverse repo facilities that the Fed has. These have been getting drained significantly, but they've been kind of offsetting the impact of the Fed's quantitative tightening or balance sheet reduction. Since it's getting drained so sharply, boy, the Fed may be pressured to adjust their quantitative tightening or balance sheet reduction, because you could have banks and stuff out there that might have some liquidity issues. So just to go over some rough numbers to show you how this can have a big impact. We have $2 trillion in debt that had to be absorbed thanks to the removal of the debt ceiling and all this debt that had to be issued. And then you have about 1.1 trillion from just you folks doing transactions out there and needing new MBS or mortgage-backed security issuance each year. And you have the balance sheet runoff of about 1.1 trillion. So total supply to be absorbed was about 4.2 trillion. Now, listen, this got absorbed last year, but it took 8% mortgage rates or so in order to do so. But what happens if the Fed starts tapering their balance sheet reduction? Well, maybe they reduce that reduction by about 400 billion. Well, that means they're going to start reinvesting that amount back into mortgage bonds and treasuries and absorbing some of that supply. This also has an impact, a trickle-down effect on other banks, where they'll absorb another 500 billion or so. So you could see that the supply that needs to be absorbed, if this were to happen, might get cut down by about a quarter or 25% or so. And this could have a very big impact. So something to watch out for. Number one, of course, we want to watch inflation coming down. X factor is the unemployment rate. If that starts to shoot up above 4%, Fed may be pressured to start cutting maybe sooner or more aggressively. But the other thing to look out for, especially at this March 20th meeting, is if the Fed makes any changes to their balance sheet reduction or what they call quantitative tightening. If the Fed starts slowing that down and starts repurchasing mortgage bonds and treasuries with some of those proceeds, that'll absorb a lot of the supply out there, and that can really help mortgage rates to come down too. So a couple things to keep an eye out for. Now, here's what the 2024 forecast is in our eyes. So I think there's going to be a range this year for rates, but I think on the low end, we could certainly get under 6% and be maybe in the, maybe if we get lucky mid, but probably more like high fives to the high sixes. And if we take a look at what I think will unlock move up buyers, I think if we get down to the low sixes or the high fives, I think a lot of that pent up demand on the sidelines will come back. And I think that that can have a huge impact on activity and on our business. And I think the 10-year is going to move from current levels, which right now are around 4.16. I think they're going to move towards 3% this year. Now, one other X factor that's out there is the potential for a recession. Last year, it seemed like most economists were forecasting a recession, but that never came to be. And now it seems like the vast majority think that there's going to be a soft landing. Basically, that means I think we're going to get inflation under control here and this whole Fed experiment without sending the United States into a recession. But I think that there's still a chance that we could see one. Having a bit of a contrarian mindset and going opposite of the herd out there, there's a lot of things that I'm seeing that are giving us some signals. I mean, we've seen the longest inverted yield curve in history. You could see things like leading economic indicators, which is a forward-looking economic report, been negative for about 22 months. And if you take a look at the unemployment rate, it can give you clues as well. Now, the unemployment rate, it recently went up from 3.7 to 3.9%. And while that's still on a relative basis somewhat low, many people out there, they'll say, we can't have a recession because the unemployment rate is low. But take a look at this chart because I want to show you when we actually get recession. So the white line is the unemployment rate, and these vertical bars are your recessionary periods. Now, conceptually, you might think, hey, we probably get a recession when the unemployment rate's high, but it's actually quite the opposite. When the unemployment rate reaches its lowest point and then begins to turn higher, that's when you get your recession. And you could see with 100% certainty in every single market cycle, that is the case, right? Reaches its low, turns higher, recession. Reaches its low, turns higher, recession, with 100% accuracy. In fact, when the unemployment rate reaches its highest point and then begins to turn lower, well, that's when the recession's over and you have your next economic expansion period. So if you take a look at where we are at right now, we're at 3.9%. That's 0.5% higher than the cycle low, which we saw back in April of 2022 at 3.4%. Believe it or not, that rate of change of 0.5% is pretty significant. If you look historically, when you see that 0.5% rise from the cycle low, in almost all cases, you're only a few months away at most to a recession. So listen, history, it doesn't always repeat itself, but it often rhymes, but it's something to keep an eye out for. Another reason to be watching that unemployment rate, because listen, a lot of times the economy looks great until it doesn't, and it can happen quickly and it can turn fast, and you could see a recession creep in rather fast and rather quickly. And if you take a look at what's been propping up the economy, a lot of it's just been consumer spending. But is it really a healthy consumer? Or is it a consumer that's tacking on a ton of debt? If you look at outstanding credit card debt, boy, that's at record highs over $1 trillion. And the rates on that credit card debt are extremely high. So servicing that debt is so expensive now, thanks to the Fed hiking 525 basis points. I mean, boy, credit card rates now, they're in the upper 20%. And then if you take a look at delinquencies on those have risen recently, just data we got today, to a 13-year high. So to me, that sounds like the consumer is under some stress out there. And if you take a look at other programs that they're using to get by now, pay later. I saw a stat the other day that 10% of consumers are using buy now, pay later programs on groceries. So listen, there's only so much credit you can have out there before the spending stops. And I think that we could be starting to see signs of the consumer under stress, which again, consumer spending is what's really been keeping this economy afloat. So I am not writing off the possibility of a recession. Now, why is this important to bring up for us, right? Because a recession, it sounds like a scary thing out there, However, the silver lining, and I don't want to sound insensitive because during a recession, people do lose their jobs and such, but the silver lining is that during recessions, inflation always declines and mortgage rates always decline. If you take a look at this chart, these vertical areas are your recessionary periods, and this is 30-year fixed mortgage rates in the white line. And you can see during a recession, mortgage rates always decline, and then they usually decline further after. And you can see that happen every single time that we see a recession. So if we see a recession or recession-like conditions, that actually can be very helpful for mortgage rates and can drive activity in real estate. Now, a lot of times people say, well, Dan, people lose their jobs during recession, which is true. But for every 1% drop in mortgage rates, it's estimated by companies out there like Black Knight that you have 5 million more people that now may qualify for a home. Whether or not they purchased or not is another thing. But just think about that. It oftentimes way overcomes the rise in the unemployment rate. And a lot of those people, unfortunately, losing their jobs, they may not be in your housing crop to begin with anyway. So oftentimes there's a net benefit there of during a recessionary period or recession-like conditions, rates coming down and seeing more activity in housing. So we've just painted a picture here, a few things to look out for, but why we, like many others out there, think that this is going to be a better year for activity and a better year for rates. There's a couple of things we're watching closely, but the Fed will begin to cut at some point this year. I think mortgage rates will move lower towards the low sixes, maybe high fives. And I think that will unlock a lot of those pent up buyers on the sidelines that are waiting. But listen, we need to generate more income right now, right? As I mentioned, you guys have made it to the next round. You guys are the survivors here, but we need to gain market share. We need to increase income. And we need to find ways to turn these buyer challenges into opportunities. So what I want to spend the next part of the presentation going over with you is what some of those challenges are that I'm sure you could relate to and ways to overcome. So listen, of course, you have buyers that are reluctant to give up their low rate and move up purchase, right? Many of you realtors on the phone, you're dealing with customers that are getting sticker shock, right? They got a 3% rate. Now they go to buy a home at 7%, and hey, they needed that extra bedroom. It's more expensive, and it's $2,500 a month more expensive. And they're like, nope, we're not going to do this. Of course, you have people that are hesitant to pay over the asking price. Is this a good financial decision? You have a ton of people on the sidelines just waiting for rates to come down. But is that a good idea? We'll go over that. And of course, you have the media that's still out there beating the drum on the housing bubble. It seems like they've been doing every single year and have been wrong. And boy, anybody listening to them would have missed great opportunities for wealth creation over the last few years. So let's go through these one at a time. How about probably the biggest one out there? People simply just waiting for rates to come down. Now, 39% of buyers, according to the NAR, say that the first or second barrier to purchasing is they're waiting for those rates to come down. And in a kind of contrarian mindset way, the higher rate can be the buyer's best friend right now. We're going to go over why. And as I mentioned, for every 1% drop in rate, you have 5 million more eligible buyers. Well, what do you think that that's going to do to demand? We already have very tight inventory today. If we see rates come down 1%, you have 5 million more eligible buyers. Do you think there's going to be more or less competition than we're seeing today? Obviously more. So this could lead to less choices. This could lead to upward pressure on home prices. And there's some sayings out there that I think are cute, but unless you really explain it, it doesn't have a big influence or impact on the consumer. And one of those is marry the home, date the rate, right? So what I want to show you is ways you can be analytical here and really illustrate this to the customer. And by the way, these are strategies that I think you should be doing. But if you want an easy way to do this, boy, make sure you talk to the PacRes mortgage professional that invited you to the call, because they have the ability to pull up tools like this within a matter of minutes and really help you with your listing appointments, with your open houses, and really help you show the customer why, in this case, they should marry the home and date the rate and buy now versus waiting. So let's go through an example. So let's say you have a customer that's in Monmouth County, New Jersey, happens to be where I'm located right now, and it's an $800,000 home. Well, the rate today, let's say, is 6.75%. And they heard me talk and they said, you know what, Dan, you said rates might come down by 1% over the next year. I want to wait for that, right? Why would I buy today? I'm going to have an interest savings if I wait for rates to come down. And they're right, they would. But here's what they're not considering. If you take a look at the property today, it's 800,000, but we're expecting appreciation in Monmouth County. The forecast for this zip code actually is 4.24%. Well, that means that $800,000 home, if they wait a year, it's not going to be 800,000. It's going to be 834,000. So they'd miss $34,000 in appreciation. And if they want to put 10% down today, well, if they still want to put 10% down next year when they purchase the home potentially, well, because the home is more expensive, they're going to have to borrow more money. In fact, instead of 640,000, they'd have to borrow 667,000. That's $27,000 more that they'd have to borrow, and their down payment will go up. So let's analyze this and see what happens if they wait, or what happens if they marry the home today and date the rate. So listen, dating the rate has a cost today because the rate's higher. So if you do the difference here between the 1% higher rate today or if they wait a year, it's going to cost them $258 a month more with the higher rate today. So over the course of the next 12 months, that would cost them almost $3,100. But here's what we're going to do. We're going to watch this for you. And of course, when rates come down, your PacRes mortgage professional is going to let you know that, hey, now's a good time to go ahead and refinance into that lower rate. But when you do want to refi next year or in the future, there's a cost to that. So let's say it's $4,000. So right now, we're going over what the costs are to date the rate. And between the payment differential, the cost to refi, it's going to cost you about $7,100 to date the rate. But here's the benefit you get of marrying the home today. Over the next 12 months, just based on a 4.25% rate of appreciation, you would gain almost $34,000. So your reason here, mathematically, to buy the home, marry the home, and date the rate is $27,000 to the plus side that you'd be. So buy the home today, reap the benefits of appreciation. When rates come down, we can refinance you. And of course, you'd still be $27,000 to the plus side by buying today. And oh, what do you think the market's going to look like when rates do come down by 1%? You think it's going to be more or less competitive? Of course, it's going to be more competitive, and that'll bid prices even higher. So these are strategies and ways that I would go over this with your consumers, with your prospective buyers, because so many of them I see out there on the sidelines waiting for rates to come down, and they're not contemplating this. And make sure you use your PacRes mortgage professional as a resource, because as I mentioned, they can pull this up for your unique scenarios and for your local markets. How about debt consolidation on a move-up purchase? So we talked about customers that are getting sticker shock, and we also talked about consumers that are riddled with debt out there. I mean, outstanding credit card debt, buy now, pay later programs. So I know you have a lot of buyers that are at low rates. And listen, life events are happening, right? They have needs and they want to move into that bigger home, right? They want to do it. They're looking at you for ways that they can get it done. So let's go through a scenario. Customer owns a home. The rate's 3.25%. They want to go buy a home today. Well, the rate's 6.75%. So they bought a home 6 years ago, and it was a $500,000 home, and they put 20% down. So their loan amount was $400,000. And then we will estimate for you on our tool what the home is worth today, $695,000, using an AVM or the appreciation in that market. And then based on their remaining loan balance and a real estate commission to sell the home, here's how much available equity they would have from the sale of their home, $317,000. And then if they wanted to buy a new home and the closing costs were, let's say, $12,000, here's how much they would truly have available for a down payment, $305,000. So what do most consumers do? And by the way, consumers, as I mentioned, they want to do this, right? I mean, maybe they had a baby, maybe they want a backyard, or they want a garage, or maybe they want a home office here post-COVID, right? So they want to do this. But here's what most people do. Almost all consumers do this. They want to buy a more expensive home. So they want to buy an $850,000 home, and they're going to take that available down payment money they have, $305,000, and they're going to put it all down towards a new home. So that means that their new loan amount is going to be $545,000, but they don't have to put that much down, but almost all of them do this. And that's at a 65 LTV. I mean, they can go up to an 80 LTV without having any kind of PMI. So let's see what happens. So if they were to do this, they put all that money down based on the higher rate. Guess what? Compared to what they're paying today, it's going to be $2,500, almost $2,600 a month more expensive. This is that sticker shock that is deterring buyers from move-up purchasing today. And I know you all are dealing with this. And this may seem like a flash of the obvious, but listen, it's important to bring in your mortgage professional and have them go over what their debts are, because many consumers out there have a ton of either credit card debt or car loan debt or different revolving and installment debts. And you may be able to take some of that available down payment, pay off some debts, and on their overall monthly obligations, get them into that new home of their dreams that they want to anyway, at a much less great of a differential between what they're paying now when you factor in consolidating all these debts. So here's what it would look like. So, hey, how about we consolidate this 99, almost $100,000 worth of debt, and we take out a bigger loan amount? Well, we're still getting you in under an 80 loan to value, meaning you're not going to pay mortgage insurance. And if we take a look at the consolidated debt savings from consolidating all this debt from some of the proceeds of your current sale, we consolidate $2,400 in savings. So compared to what you're paying today versus if we were to buy this new, bigger home that you want to do anyway, hey, the differential looking at all your obligations is only $130 a month. And so many people are utilizing this. Listen, is it going to work for everybody? Of course not. But it's a great strategy to show consumers take out a bigger loan amount. Don't take all the proceeds and put it down on the new home. Pay off some of these debts. And on your overall obligations, get into that home of your dreams at much smaller of a deficit than originally thought. Now, how about customers that are simply just getting outbid? They're getting guidance that, hey, you need to come in over asking price to win the home. And they don't want to do it, right? I mean, they don't even want to pay full asking price, let alone bid over the asking price. And they wonder and look to you, hey, is this a good financial decision? Well, according to the NAR, 29% of buyers are citing competing offers as the first or second reason why they are not purchasing a home. And you could see about 30% of homes today are getting bid above the asking price. And there's 2.6 offers per home listed on average. So let's look at another example. So customer looking to buy a home, it's worth $630,000. They're asking $630,000 for it, and they put in a full price offer. But unfortunately, they get outbid, and somebody comes in at an offer of $640,000. So to win the home, you have to bid $15,000 over the asking price. So your total bid is $645,000, but the home's only worth $630,000. Many consumers don't want to do this, right? Is this a smart financial decision? And they have some questions. Number one, what is the home really worth? But number two, if I got a bid over asking price $15,000, how long is it going to take for me to break even? How long is it going to take for the value of the home to reach my bid? And what does the future look like in this market? All I really want to know is, am I making a smart financial decision? Well, the customer tells you that this is going to be their forever home, or they're going to live in there for 9 or 10 years, right? Well, your PacRes mortgage professional can pull up a bid over ask tool for them and show them for their specific scenario in their specific zip code. Well, hey, for that home and your 15,000 over asking price, how long is it going to take you to break even? Well, based on the forecasted rate of appreciation in your market, which is 4%, it's only going to take you 4.9 months to break even. It's the magic of appreciation. And over the next 5 years, the forecasted rate of appreciation per year in your market is 4.28%. Is that a crazy high number? Well, the 63-year historical average per year is 4.5%. So very much in line, in fact, below what we've seen historically in this market. So what does that mean for you? Is it a good financial decision? Well, over just the next 5 years, the home is projected to increase in value to $783,000. So your gain, even factoring in the $15,000 over asking price over just the next 5 years, would be about $138,000 that you would gain in appreciation. So yeah, it seems like a pretty smart financial decision. And again, the customer wants to do this. You have to show them ways and help them get comfortable with it. Now you can walk them through the story where, hey, look at this timeline. Over the first year, initially you'd be down $15,000 bidding over the ask, but in 4.9 short months, you'd break even. And then over the next 5 years, you could take a look at what would happen based on the forecasted appreciation market rates in your zip code. And this is what it looks like where you can brand this or co-brand this with your PacRes mortgage profession. And so many people write in, whether it's realtors or mortgage professionals, saying that they use this tool. They showed the client they would break even in only 4.6 months on what they indicated was their forever home, and showed them the value of what it would reach over the next 5 years. They saw this, chatted with me over the phone. They called their realtor and they inked the deal. The one deal alone was worthwhile. So make sure you're leveraging your PacRes mortgage professional to utilize this stuff. Now, how about buy versus rent opportunities out there? One thing that I could tell you that drives me nuts is I see these articles, whether it's on realtor.com or different websites, and they very definitively say it's better to rent than buy in every market in the country. And I look at this and I'm like, boy, how can this be? Let me dig into their methodology. And when you look at it, it's very clear what they're doing. All they're doing is looking at the monthly payment differential, and they see that it's a higher cost to buy versus rent. and they're saying it's better to rent than buy in every market. But that's all they're looking at. I mean, why would you not factor in amortization, appreciation, tax benefits? And how about rental increases, which we're seeing renewals on rents going up at about 4.5% a year? Let's not factor any of that in, right? So it's kind of clickbait out there, but I want to show you how you can have a steelman argument against this. So let's say you have a purchase price of $500,000 and customers putting 10% down. So it's a $450,000 loan amount, and the rate on a 30-year fixed today, let's say 7%. The monthly payment is going to be $4,378 per month. And if you do a comparable rent in this market, it would be about $3,651. So this is what the media sees. It's $727 cheaper to rent versus buy in this scenario. And they run with that and say it's better to rent in this market. But you have to factor in other things. Rents are going up on renewals in this market by 5%. And this customer is going to be in the home for 9 years. And let's factor in some negatives that even these articles aren't factoring in. We want to be fair here. Hey, property taxes, they often go up. Let's put a 2% escalator in there. You're going to have maintenance and repairs that if you're renting, you won't be responsible for. Let's smooth that out. Let's say it's about $2,500 per year. And when you go to sell the home in the future, let's say you pay a 6% real estate commission. Now, over the last 63 years in this market, the average rate of appreciation is 4.2%. But the forecast is a little bit beneath that in this market. It's about 4.1%. So let's use that number. So if you look at the results, it's $4,378 on a total expense basis to buy versus $3,651 to rent. So, a couple $1,000 or $1,700 or so more expensive to rent versus to buy versus rent. However, let's break this down and look at the payments. So on an absolute basis, because of that rental increase, believe it or not, it actually starts to get more expensive to rent versus buy by year 6. But it's actually more expensive to rent versus buy before that when you factor in principal, because your principal that you're buying is $393 a month. So, and that's on the first month here. So that increases. And if you take a look at this chart here, by year 4, when you factor in the principal, it's actually more expensive to rent versus buy. And remember, the rents are going up 5% a year in this market. Now, over the course of the 9 years on an absolute basis, believe it or not, because of the rental increase, you're going to be about $2,300 cheaper on a cash flow basis to buy versus rent. But after the first year, you'd put $4,600 towards principal in your principal and interest payment. And over the 9 years, you would amortize or gain $55,000. That's your own money. And at just a 4% rate of appreciation, many people can't fathom this. So you have to show it to them. That home would increase by $219,000, almost $220,000. And that's just at a 4% rate of appreciation. Listen, there's a reason why Albert Einstein said the 8th wonder of the world is compound interest. You have to show this to them. There's a tax benefit of buying versus renting over the standard deduction over those 9 years of about $21,000. And let's factor in a big negative $43,000 on the future value of the home when we go ahead and sell that home using a realtor. So if somebody were to ask me or one of the PacRes mortgage professionals, is it better to buy versus rent? Or now you can pull this up. And I think many customers would be surprised to see that, hey, after 9 years, factoring all this stuff in, you're $245,000 better off buying versus renting. Now, listen, if you're going to be a home 1 year or less, you're not going to be able to overcome the cost to buy and the cost to sell. So you should rent. But anything after that, you should definitely be buying. Listen, there's a reason why, on average, the latest stats show homeowners have 40 times the net worth of a renter. And this is another piece that can be branded with your PacRes mortgage professional and shared. And it's extremely effective, team. You should be using this at all your open houses to really show buyers why they should be purchasing in that market. Now, we talked about the media that's been beating the drum on a housing bubble. Well, let's take a look at a little deeper dive as to what we've actually seen happen with housing. So there's appreciation reports out there that actually track the changes in residential home values. And here's some of my favorites here: Case-Shiller, FHFA, CoreLogic, and Blackman. Now, this is very different than things like the median home price, which we will go over. But you can see these reports, they come out every single month, and they show you how much home prices have gone up or down. Now, if we want to just rewind a little bit, remember back to 2022. The first half of the year, we saw rapid home price appreciation. It went up by about 9% into the then peak of home prices in June of 2022. But then we saw home prices start to come down a little bit. Second half of the year, they started to move a little lower. The media was calling for a housing bubble. Well, at worst, they came down nationwide about 3%. But full year 2022, we still saw 6% appreciation. Media was calling for a housing bubble in 2023. What happened? Well, if you look at all these different appreciation reports, you can see January of 2023 was really the inflection point. And then home prices not only started to rise, but accelerate. And you can see where I have these yellow highlights. This is when that report said, hey, we hit a new all-time high in home prices, surpassing the June 2022 peak. According to Case-Shiller, which I think is really the gold standard for appreciation out there, as of July of 2023, new all-time high, and every single month since, we've continued to set new all-time high in home prices, despite the media calling for a housing bubble. FHFA said that happened in February. CoreLogic and Black Knight said that happened in May. And on a year-over-year basis, you could see we're somewhere between 5.5% and 6.6% appreciation. So let's just call it 6% appreciation here, rounded for 2023. So 6% in 2022, 6% in 2023, yet the media is still calling for a housing bubble. And the media likes to cite things like the median home price. And this is one that will definitely trick you up, will definitely trick up your customers. So I want to just use an oversimplified example to show you what this is really measuring, because it's not measuring home price appreciation or depreciation. So if you remember back to your economic days, you had your mean or your average, and you had your median or your middle. So the median home price is quite literally the middle priced home that's sold. Half the homes sold above that price, half the homes sold beneath that price. So let's look at 2022 and use an oversimplified example. If during that whole year, only these 5 homes sold, 300,000, 350, 400, 450, 500, these 5 homes sold, here's the prices. What's the median home price? Well, it's the middle priced home where half the homes sold above it, half sold beneath it. So it's 400,000. Now, we just went over the appreciation numbers for 2022. We said it was 6% appreciation. So that means nationwide, on average, homes appreciated by 6%. So that means all these homes would increase in value by 6%. But then what happened in 2023? Rates went very high. We saw much less activity, higher homes. A lot of them were sitting. So let's say in 2023, only the first 3 homes sold. So only these 3 homes sold. Well, what is the middle priced home now? Well, now it's moved all the way down to 371,000 because of the mix of sales. So when the media is out there quoting that the median home price is down, in this example, the median home price fell 7%, even though we know home value is actually appreciated by 6% on average across the US. So the median home price can be skewed. A lot of it has to do with the mix of sales. Don't be tricked up, or let your customers be tricked up by that median home price. And as I mentioned, the media is out there talking about a housing bubble. Once again, Diana Oleg, our friend on CNBC, she seems to always be having a negative skew on housing. And boy, since 2015, almost 10 years or so, she's been talking about a housing bubble. And you can see some of the articles. And I took the liberty here of showing you what the actual appreciation was and what the impact would be if a customer listened on how much they would miss. But 2015, a bubble larger than 2006, we saw 5% appreciation. 2016, we're in a new housing bubble, 5% appreciation. 2017, homeownership doesn't build wealth. Well, anybody that bought a home back then would disagree. We saw 6% appreciation. 2018 is better to rent than buy. Well, we saw another 5% appreciation. 2019, the housing market's going to shift in a bad way for buyers. It shifted in a bad way if you didn't buy. We saw another 4% appreciation. 2019 in December, next year is going to be hard in the housing market. Well, we saw 10% appreciation. 2021, the housing boom's over, 19% appreciation. 2022, why the housing market's in big trouble, 6% appreciation. And 2023, home prices may be turning lower. Well, we saw another 6% appreciation. So you can't listen to the media. You need to explain this to your customer. And listen, what determines price? Well, in most cases, it's supply and demand. If you want to see what a housing bubble looks like, look no further than 2007. If you look at the existing home inventory, then there was 4 million homes for sale. Today, there's barely a million. So 3 million less homes for sale. This is what a bubble looks like. This is not what a bubble looks like. You need to have something to sell for a bubble. And if you take a look at population versus inventory, back in 2007, you had 301 million people in the US and 4 million homes for sale. Fast forward to today, you got 39 million more people in the US and you have 3 million less homes. No wonder why home prices have been supported. And the existing home inventory number of 1 million homes, doesn't tell the full story because that number comes from the NAR, National Association of Realtors. And believe it or not, they include homes that are under contract within that figure. And that's 336,000 homes. So if you want to really see what inventory looks like, it's even lower than that. Active listings are 665,000. And where does that stack up historically? Well, it's about half or less than half of what we would expect to see in a normal market. So inventory is extremely tight. Now, another argument I see the media make is that, well, hey, look at the last few years. We've seen some really big appreciation. We have to see a housing bubble. Well, does that hold true in history? If you look since 1941, right, the housing market's record has been 75 and 6. That means that home prices have gone up 75 years and they've gone down 6 years. And almost all of the decline was during the housing bubble. So just because we saw home prices go up, it doesn't mean that we're due for a housing bubble around the corner. Look at some examples. 1943 to 1947, home prices went up much more than we saw over the last few years. They went up 118%. Did that mean we had to see home prices turn lower? Well, you would have had to wait almost 60 years until the eventual housing bubble. How about 1974 to 1979? Prices went up 93%. Did we have to see home prices turn lower after? We would have to wait about 27 years or so until the housing bubble. So obviously the question is, hey, are we at risk of going into another bubble-like condition? Because just because we've seen home price increases doesn't mean that we're due for a housing bubble. Well, let's just reiterate here. Inventory couldn't be more opposite than what we saw during the housing bubble. 1 million homes versus 4 million homes. But how about looking at demographics and looking at household formations versus completions? So formations are your blue bars on this chart, and that shows you demand. That's kids living at home with their parents. They move out to buy or rent a home. That's a new household, a new demand component. Or maybe a married couple living together. They get separated. Well, now you have a new household that needs to live somewhere. And then the gold bars are your completions. Those are builders completing homes and putting them on the market. Well, if you take a look during when we know we had some trouble here, look at how much more completions or supply there was than formations or demand. Huge disparity. Of course, this is part of the reason why we ran into a housing bubble. You had a glut of existing supply. You had builders putting up 2 million homes per year, and you didn't have enough demand to sop up that supply. Look at how that's reversed over the last several years and how much more you have in the way of formations than completions. And of course, we know back here you could fog up a mirror and get approved for a loan. Things have changed drastically. Lending standards are much higher, much better today. So in my opinion, we are not at risk of a housing bubble. In fact, I think that if we see rates come down, you're going to see home prices accelerate. And, another thing I like to show customers is, people aren't buying housing like they are stock, right? I mean, this is something that you're going to be in for typically a good deal of time, right? Maybe it's 10 years on average. Housing is one of the safest investments, especially when you look at it over a longer period of time. If you go back to 1942 and you just used a $100,000 home as an example, obviously it's multiples of this in real life, you could see after 10 years what the return would have been or how much home values increased since then. And going back here to 1942, every single scenario here, you would not have gotten hurt and you would have done well with purchasing a home except for 1 year, which was 2006. So housing is an extremely, extremely safe investment. Now, want to just wrap up here talking a little bit about our forecast for 2023. So 2023, the year that just passed, we had a appreciation estimate at MBS Highway of 6.8%. We saw, according to Redfin, around 6.4%, and some of the others I just showed you, somewhere between 5.5% and 6.6%. So I'd say it was pretty close, right? And if we take a look at the 2024 forecast, we believe that we are going to see about 5% on average appreciation full year for 2024. And we think we're going to see transaction volumes up somewhere between 10 and 15%, which will be meaningful. Now, you might ask yourself, or a customer might ask you, well, 5%, it doesn't sound like that much. Is that good? Well, I think it's important to illustrate for your customers what even small levels of appreciation can mean, especially when you factor in the concept of leverage. So a quick example, customer buys a $500,000 home. Listen, you got to live somewhere, whether you're buying or renting. You got to pay monthly to live somewhere, unless you're going to be like Will Ferrell and Step Brothers and live at your parents' house till you're 50 years old, right? So that's a given. So when you buy a home, your investment, your out-of-pocket investment is really your down payment. So if you buy a $500,000 home, you put 10% down, that's a $50,000 investment. Now, we just said we expect 5% appreciation over the next year. Well, that means that hey, you wouldn't just get that 5% on your investment, but on the whole purchase price. So 5% appreciation on a $500,000 home is $25,000 in profit just over the next 12 months. So what is that as a return on your investment compared to your $50,000? It's a 50% return on your money, which is extremely exciting. And again, this is the concept of leverage. We also have a MBS Highway Housing Index that, boy, we'd love if you guys would participate in. We do this every single month. And boy, just looking at the different regions and overall, we're seeing activity picking up about 5 points on a year-over-year basis, but increasing back to the 50 level here, which gets you back into some expansionary numbers, and home price direction up to a 62, increasing. So we're seeing a little bit more pricing pressure out there, and we are seeing activity begin to pick up, especially in some of these different regions. But your PacRes mortgage professional can not only help you with the tools that I just showed you going through these different scenarios, but they can pull up an AVM for you, which helps to show you home values as well as comps in the area. They can also pull up a real estate report card for you for any zip code or any address out there and show you what the historical and forecasted rates of appreciation would mean to your customer, what the supply looks like, demographics, the incomes in that market. And again, all this stuff can be branded or co-branded with your PacRes mortgage professional. And I think all of your open houses and all of your listing appointments should have some of these customized pieces. I think it will make a meaningful difference. And the last thing I want to lead you with is, remember that article that we kind of led off with from American Banker, Is It Time to Quit Mortgage and Real Estate? Well, there's one thing that I left out, and that's that this article was actually written in 2014. Kind of some eerily similar circumstances. And listen, we talked about how there's been about 50% attrition in our business, whether it's mortgage or real estate. People quit back then, but guess what? They were right around the corner, and they missed potentially the best 8 years that we've ever seen in the business. So, you guys are the survivors here. Certainly don't quit. Make sure you capture that market share. Make sure you're educating yourself every day. It will make a big difference. And make sure you're leveraging the tools out there that you have available to you that your PacRes mortgage professional can get for you to help you be more successful in all these different scenarios and overcome these challenges that I know you're dealing with on a daily basis. But thank you, guys. Dave, thank you for having me. I hope it was helpful.
Dan, it's always awesome, and so appreciate you joining us, and right on time as always. Is there any questions out there that people want to come off mute and ask Dan before he leaves us? Quiet group. So Dan, I heard in the news this morning that the Biden administration is trying to come up with something, a $5,000 credit for first-time home buyers and a $10,000 credit for somebody who sells a
Yeah, I
home.
don't like that idea. My opinion on that is I think that they're trying to do something good to help people, but I think that they don't see the unintended consequences. We've seen this happen in the past, where if you do that, all that's doing is creating more demand that's going to bid prices higher. I think the real problem that we have right now is rates, which hopefully will start to come down. But a lot of times those credits will just exacerbate the scenario that we're seeing, and I think ultimately would drive prices higher.
They're not trying to get votes, are they? Awesome. Well, I don't see any other questions in the chat box. Nobody else wants to come off mute. Then
I saw somebody, Debbie. I think Debbie said something about not worried about the reserve currency. So listen, I certainly am worried about the debt that we have. We're $34 trillion in debt. We have a spending problem in this U.S., whether you're a Republican or a Democrat, right? I think everybody's got a spending problem, right? And I don't like to get political or anything. I know it's an election year, but I don't see any good plans for getting rid of the debt. I don't think that anybody's going to win on the ticket of, hey, let's do a hard reset and not spend anything, right? But listen, not to get too personal, but one of the reasons why I'm a big believer in Bitcoin, I actually have a service that I provide called Crypto Charged, where I educate people on the crypto markets in addition to what I do in the mortgage and real estate market. So if you want to check that out, it's cryptocharged.com, and you could sign up for a trial there. But certainly I think it's a big problem. I don't think that the U.S., at least now, was at any risk of losing its reserve currency status. I think that that's a long ways down the road, but it's something to keep an eye on.
awesome, Dan. Well, as always, we appreciate you more than you know. We appreciate all the tools on MBS Highway that you presented today. And so if anybody out there has questions on that stuff, please reach out to your PacRes mortgage advisor.
Hey,
Yes,
Dave,
sir.
one thing I wanted to just add. Listen, I always love to keep in touch with people that are on these calls. And um, one of the things I do, I don't originate, but I post videos that you can share to strum up activity with your database, or videos that you can just kind of copy and then create them for your own social network. So I really do it to help you. I just wanted to just show you really quick what my social is, because I'd love to keep in touch. But also, you can come in here and either share some of these videos, or you can steal them and just create your own. That's what they're there for. But my Instagram is the Dan Habib, and you can see it's literally just all videos like this that hopefully will help you to strum up some activity in your social network. Again, it's just the Dan Habib. Would love to keep in touch. But thank you, guys.
Awesome, Dan. We'll look forward to having you on probably next quarter. And thanks again
Sounds
for your
good.
time.
Well, thank you,
Thanks,
guys.
everybody.
Take care, everybody.
Have a great day.